Hello, and welcome to the January 2019 market update from Commonwealth Financial Network. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. We had another terrible month in the financial markets. Here in the U.S., markets were down about 10% pretty much across the board. Internationally, things were better, but they were still down about 5 or 6%. One more in a stream of tough months, and the question we have to ask ourselves is, what the heck happened, and is it going to continue? When we look at what happened, I think it's pretty clear. A lot of worries that the market has been ignoring for months, if not years, all came home for the holidays at the same time. We have a government shutdown, which of course always hurts market confidence, always hurts economic confidence, and in this case it seems to be persisting because the White House and Congress are really locked in a face-to-face battle. That's very concerning. We have the Fed raising interest rates and even worse, suggesting that they were going to keep doing so, which was not what the market wanted to hear. Interest rates are the foundation of all financial assets, and for the Fed to keep raising rates, that usually rattles markets as well. Of course, that's not all. We also have China and the trade war. We have Brexit in Europe, and there are signs that the economy is starting to slow down a bit. In other words, we had a whole bunch of worries really hit right during the holiday season, and the market reacted by pulling back. That's not a surprise. In fact, that is what should happen. But the question we have to ask ourselves is, will this continue? And I think there the news is a little bit better. Because when you look at each of those items, if you look at the government shutdown, yes, it's concerning. But historically, government shutdowns have been pretty short-lived. And when it ends, we will actually have a deal on some fairly contentious issues. And that will help market confidence. When we look at the Fed raising rates, yes, they're raising rates, but at the longer end, which is more important, rates have actually come down significantly over the past month. And that's going to help support asset prices. When we look at China, when we look at Brexit, there are two areas where we're actually seeing some real progress. And when we look at the economic slowdown, yes, growth may be slowing, but we're still growing. And even if we slow, we're still going to be growing at about the same rate we have for most of the recovery. In other words, for all of the worries that showed up, for all of the headwinds that we saw, they're likely to at least subside and probably reverse in several cases over the next month or so, which suggests a couple of things. First of all, it suggests that a lot of the damage has been done. Yes, there has been damage. Yes, it's very real. But there are also signs that this may be as bad as it gets. We also have the fundamentals continuing to improve. The economy continues to grow. Consumers continue to spend. Businesses continue to hire. In other words, the fundamentals are sound, which should help us bounce back as well. Of course, none of this is guaranteed. We'll have to wait and see what happens, but right now, as bad as this month and the past couple of months have been, the future looks brighter. And with that, I'll talk to you next month. Thanks for watching.